The past few weeks have been marked by choppy trading, especially heading into the final sessions of the first quarter. Today was highlighted by the epic clash between forced pension selling and quant buying while moving into the month and quarter end. As for me, I had a Goliath week. In Friday's trading, the morning saw stocks dumped. Was that rebalancing? But once again, as Europe closed, the standard trend reversal struck, and with an hour to go in the trading day, the quant buying went into panic overdrive. But overall this week, the cyclical, energy, financial, and industrial sectors, those sectors which were the biggest laggards of 2020, were outperforming for the year to date. At the same time, last year's leading technology companies are now the laggards. Perhaps it's just a sign of improving economic growth and Thursday's bigger than expected drop in new unemployment claims. It's just getting harder for the pundits to keep up with this economy. And this week, Bank of America economists raised their forecast for real gross domestic product growth this year to 7%. That compares with the Fed's median forecast of 6.5% growth this year. Things are moving so fast now that the expectations are for a near term burst of inflation as demand increases faster than supply. So, with the people locked up for a year, who would ever expect spending and demand to pick up once the lockups are removed? Only a genius would have figured that out. Thankfully for us, we have the charts. So, let's go. Today we're going to look at one chart, which is the 2-year weekly chart on the spiders, the SPY, and the close on Friday was 395.98. And as you can see here, say since November, it's been a pretty good run all the way up there in this channel. Now, we're going to stay there, I think, for the foreseeable future. And here's why. Moving down into the oscillators, volume looks fine. We're not going to spend any time there. But here, this is the MAC. And again, since November, from that rise of the fast line above the slow line, it's continued on. Now, the fast line did come below the slow line here in the last few weeks or so. But if you remember me talking about this before, when the fast line and the slow line move together in tandem, almost pasted with the elevation that they have above that zero line, things are going to go well in the stock market. The MAC's going to go sideways, but the stock market's going to go up. Moving here into the histogram, you can see pretty much the same thing, very low volatility. Here, the price rate of change, same thing. Look at that run above the zero line. Now, it's below 75, which means it's not overheated, and it can continue to go sideways for some time. Here into the relative strength index, once again, 65.03 is moderate. So it's not overheating, but it's elevated above that midline or 50. So it's going to continue to run within this area here too. It's not too cool and it's not too hot, just nice and mild. Stochastics, same thing. You can see the bottoming here and basing here with the fast line running up and through the slow line. So I think the stock melt up continues. As well, shown here in the Williams, elevated above that 50 line, we're into the overbought territory, but it can stay there for months. Back up here to the price chart, one last look. This is the time that you be patient. If you're invested, just be patient and watch those stocks run. And for today, that's ChewDog Charts. Thank you.